Okay, so let's talk about Philip Morris International. They just dropped their Q3 numbers, and on the surface, they looked fantastic. So, why on earth did Wall Street absolutely hammer the stock, sending it into a free fall? That's what we're going to decode today, the earnings beat that completely spoke to the market.
And this, right here, is the puzzle we need to solve. You've got strong financials on one side. They beat expectations, they even raised their guidance for the year. And on the other side, the stock gets crushed, a brutal 9% plunge during the day. So what gives? What did Wall Street see that the rest of us might have missed in those headline numbers?
You know, on any other day, a classic beat and raise quarter like this one, that's rocket fuel for a stock. It should have been soaring. The fact that it did the exact opposite tells you everything. The market was reading a completely different story, one that was buried somewhere deep inside that report.
So to really get why everyone panicked, we first have to appreciate just how good the results looked. Let's break down those top-line numbers, because this is the good news part of the story, the part Philip Morris was really hoping everyone would focus on.
All right, first up, profitability. Adjusted earnings per share, or EPS, came in at $2.24. And listen, this wasn't just a tiny beat. We're talking almost 7% higher than what analysts were calling for. That is a really strong signal. And it wasn't just the bottom line either. The top line was solid too. Net revenue hit almost $11 billion, also beating the street's expectations. So think about it. They're bringing in more money and turning more of that money into profit than anyone expected. Everything's looking great, right? And when you look at what's driving that growth, it's crystal clear. Their smoke-free products now make up a whopping 41% of total revenue. I mean, this is a huge milestone. It's proof that their big strategic pivot away from traditional cigarettes is really paying off. And this right here is what that strategy looks like in action. You can see it plain as day. The volume of their new heated tobacco units, it shot up over 15% compared to last year. At the same time, traditional cigarette volumes, well, they're going down. So this transition, it isn't just some idea on a PowerPoint slide. It's happening right now, and it's actually picking up speed. Okay, so we've got a strong beat, we've got a guidance raise, the core strategy is working. Which brings us back to the big question. What on earth caused that massive sell-off? Well, the answer is hiding in one single gigantic line item, an expense tied directly to their key growth product here in the US. And there it is, a $100 million hit in one quarter. This was the price tag for a huge promotional blitz for their oral nicotine pouch, Zyn. See, they'd had some supply issues, and once those were fixed, management decided to spend big, and I mean big, to get back that momentum and fight for shelf space against some really tough competition. Now, management had a story ready. Their defense was pretty clear. The CFO, Emmanuel Babeau, he called it a blast effect. He framed it as a one-time, totally exceptional expense designed to jumpstart Xeon's growth again. Basically, they were saying, hey, this is a strategic, short-term cost we're paying for a huge long-term gain. But the market heard something completely different. The fear wasn't really about this specific $100 million. No, the real fear, the question that absolutely torpedoed the stock, was this. Is this truly a one-time thing? Or is this the new normal? Is this the punishingly high price they now have to pay to compete in the super lucrative US market? And that uncertainty is what vaporized billions of dollars in market value, just like that. So to really get why this one number could cause so much panic, we have to zoom out for a second. We need to look at the company's entire long-term strategy, because that's what puts this spending into a much clearer context. Look, the entire investment case for Philip Morris really boils down to this three-step plan. Step 1, get away from the slow death of the traditional cigarette business. Step 2, build a whole new empire around their heated tobacco product, IQOS, mostly outside the US. And then Step 3, use Xeon to go after and conquer the huge American market. So that $100 million spend, it was all about protecting Step 3, the absolute crown jewel of their entire future growth story. And here's the thing, up until this quarter's little surprise, the plan was working perfectly. I mean, they're in 100 markets now, IQOS is completely dominant in its space, and these new products are driving the bulk of their profit growth. They even raised their guidance for the full year. So you see, the crucial point here is that any threat to that Xeon growth story isn't just a minor issue, it's a potential threat to their entire long-term vision.
So the big question is, where does this leave investors? And that brings us to the next call. We're going to lay out the key things you need to be watching for and what a potential path forward for the stock could look like as this tug of war between management's story and the market's fears plays out.
Okay, so when the Q4 report drops, here's what we're going to be laser focused on. First, how did ZN actually sell over the holidays? After that big promotional push. Second, are we going to see any weird inventory adjustments for either ZN or IQOS? And third, and this is the big one, what is management going to say about promotional spending in 2026? Seriously, their commentary on that one point, it's going to be everything.
So here's how we think this could play out over the next year or so. For the rest of 2025, especially around the Q4 report, expect the stock to stay choppy as the market desperately looks for clarity on margins. Then, moving into early 2026, if that spending comes back to normal levels and the growth is still there, you could see the stock start to stabilize. But the real change, the big re-rating for the stock, that probably doesn't come until mid-2026, once we have enough cold, hard data to prove whether this U.S. strategy is actually as profitable as management keeps telling us it is.
So, when we put it all together, our rating on the stock is market perform. Look, the company's long-term strategy is sound, and their ability to execute is undeniable. They've proven it. But that near-term uncertainty about the cost of growth in the US is a major, major overhang. It basically cancels out a lot of the positives for now. At the end of the day, the market needs proof, not just more promises. So ultimately, it all boils down to one simple question. Was that $100 million spend a one-time investment to restart an engine? Or was it just the first payment on a much, much higher bill for competing in America? And of course, a final reminder that this is not financial advice. This is just our breakdown of the latest earnings report.